from my experience, when I've slowed down, solutions to things that I've been grappling with just like spring up.
Mm.
Solutions like these it seems like creativity comes to you so easily when you slow down and give yourself that sense of rest. So yeah, you had sent me a text or an email yesterday and said, "Well, we haven't got a topic. What do you know?" And I thought, "Oh, well, I didn't push any topic either, because I kind of thought it would be cool not to have one." But I got to tell you that my world has shifted since you and I had talked about this, which was the 4 things that make cash value grow. And I think that so that topic and the other topic I find really fascinating too is that I never really thought about it, probably really didn't even quite understand it in detail. I gotta say, the insurance companies aren't known, even though they put on webinars all the time and everything.
Yeah.
They don't actually communicate personally all the time with us and teach us stuff, the intricacies of things. So the other subject I'd like to, besides the 4 things that make cash value grow, but also what's really cool is when you take a loan from your policy, you're not actually taking it from your policy, right? Everybody knows this. Well, I shouldn't say
Right.
everybody, but you're you're collateralizing your policy, and you're taking it from the insurance company's general fund. But what's cool about it, that I find so cool, is that when you're paying it back, all the money that you're paying back in that year, just say, for instance, as an example, I tend to use my wife's policy as an example because hers is a little older than mine. Well, we started hers first. We take a loan, say in August, and her anniversary is in July. If we take a loan in the day after her anniversary, we have a whole year to send money back. I'll call it our savings account. We have a loan against our policy, but all that money that we send goes directly to the principal. So, for instance, right now, her interest rate on the loans that we took a year and a half ago for putting our addition on our house was 5%.
Okay.
And you made a good point, and I don't know, it was on that show or it was just in passing, that all that money you send goes directly to principal, even though it is accruing interest on a daily basis. But as you're sending that money, just for instance, we send $500 a month, say it's that. It's knocking down that principal. So the amount that it's daily increasing the interest rate, the interest amount is going down. So as you pointed out, it's not truly 5%.
No. and neither is 3.5% or whatever we're at right now, 8.5% on a mortgage. It's not 8.5%.
Oh, geez. Well,
right.
Yeah.
So no matter which way you cut it, as anytime the word interest rate is said, you may as well forget about it. Like right after that, because it doesn't matter. It really doesn't matter. The interest, Nelson was so accurate when he said it, is what you pay by volume that matters. And the volume is changing. Like if you don't pay your policy loan back at the end of the year, and then you accrue that, the interest on 5% for that entire year. Let's just say your loan was $10,000. Right. 5% of $10,000 is $500.
Yeah.
Is that right?
Right.
$500 would be added to your loan balance. Now you're paying 5% on $10,500 instead of 5% on $10,000. Well, obviously, if you take 2 or 3 years to pay off the loan and you calculate the total volume of interest, you're going to be a little bit higher than 5%. But compared to what? Also, if you pay it off within 8 months, you're going to be lower than 5%.
Right.
So it it makes it real confusing when we focus all of our time, all of our energy, all of our brain power on the percentage. It's not the thing that matters.
Yeah. It isn't. It isn't. Uh, you're absolutely right. It's great to bring up that point that Nelson tried to emphasize.
Hmm.
It's not the interest rate, it's the volume, as you've already pointed out. But what's really also, and you just mentioned a mortgage. A mortgage, first off, if you have a mortgage with the bank, like if we had taken a loan out, $50,000 loan out with the bank for this addition we put on, and we missed a few payments, there would be a conversation coming up.
Hmm.
But with the insurance company, they don't care.
Yeah.
It's totally collateralized for them. They know they're going to get their money back.
Yeah.
And geez, if you want to run it all the way up, we die 30 years from now, and that $50,000 loan has become, let's say, for instance, 100,000. So they're going to get their 100,000.
Yep.
But when you compare it to a mortgage that you've taken out with your local bank, and they tell you it's, well, in this day and age, it might be, I don't know what it is today, what the rate is, but 6% or 6.5% or whatever it is. It's not really 6.5%.
Mm-mm.
if
No.
you've ever, I'm saying it facetiously, because probably most of the people that are listening, a lot of them have taken out mortgages, especially if they're my age or in their 50s or whatever, 40s. They've taken out a mortgage. And when you make that first payment, it's totally the opposite as the insurance
Yeah.
situation, where you say your mortgage and interest, and maybe your insurance is in there and your taxes. But just say it's your mortgage, just that section of your mortgage, and it's $1,000. When you make that very first payment, maybe $30 or $40. Who knows what it is? But it's really small piece of that $1,000 is going to the principal.
Yeah.
The 950, they're just taking it.
Yeah. I think when you average the volume of interest that's paid on mortgages, because the statistics are that Americans will move every 8 years on average. You kind of average that out across everybody, the average mortgage rates and all this other kind of stuff. By volume, it's about, I think it's 82 or 83% of
Yeah.
mortgage payments for the entire life of the individual goes to interest. I mean, just lining the pockets of the banks.
At
That's it.
83%.
83%. That's insane. You're you're building equity with 17% of your monthly payments that you're fighting to afford a lot of times. It's
Right,
insane.
right. Yep, it is. It's just crazy.
That is actually what started the whole process for me getting into infinite banking, because my dad was tired of that. He realized that, and he's like, there's got to be a more efficient way to pay off this mortgage. And so he started going down this path of like, what are the other options besides this mortgage? And he came across HELOCs, and then through HELOCs, he learned about infinite banking. And then he read Becoming Your Own Banker, and he's like, Kyle, you got to check this book out. So I read the book, and yeah, it was that was just maybe. Well, I told him no like 3 times. I'm like, I'm not gonna worry about it. I've got too much other stuff going on. And he's like, you really should read the
Right.
book. For like 6 months, he was telling me, and he kept telling me how excited he was about what he's been learning and all this kind of stuff. And finally, like, he he doesn't do that kind of thing very often. And I just decided, okay, I'll read the book. And then I attended a live seminar, a 2-day seminar, and been blown away and chasing it ever since.
So did you go to Nelson's 2-day seminar?
Ryan Griggs.
Oh, okay. Yeah, I mean and that's the situation for so many of us that I haven't got time for that.
Hmm.
I've got so much going on. How can I possibly? But yeah, it's interesting you say that your dad doesn't normally do that. So that probably got your attention that he kept on pushing on it,
Yeah.
tapping on it, saying you should do this, you should do that. um, and I think that's what you and I are doing. We're just putting these messages out is that we're, tapping on people, just saying, hello, you should look at this.
Right.
So I found that really fascinating when that really came, when the real light bulb went off. Like just understanding the concept of being your own banker, I got that, and I was like, okay, I'm in.
Hmm.
I was in. But the things that I've learned in the last it's coming up on 5 years, um, and just recently, you and I talking, it's like, holy mackerel. So talking to different practitioners, everybody seems to have a piece, and
Yeah.
it's been fun. But then so there's that, the way that interest works inside of these kinds of policies. Um, there's probably not a lot of places that it's like this.
No, and here's the other thing. I'm speaking to the companies, the carriers, I should say, that I am aware of. Um, there are other carriers who have different rules, right? Every company's going to have their own bylaws, their own standards, their own
Right.
way of doing business. So I can't speak for everyone's particular policy. If you have different companies,
Right.
maybe a portion of your payments go towards interest. And I would say if that's the case, maybe consider getting a different company on your next policy.
Yeah.
You know,
Right. Right. Yeah. I'm actually not aware of any companies that do it differently, but the mutual or
yeah,
fraternities,
I'm not either. I'm not either. I just figured I'd throw that out there because I don't want to speak to something that I'm not aware of. Right.
Yeah, yeah, and yeah, because I have no idea what all those hundreds of stock companies, insurance companies, stock owned um, companies are, how they operate. I don't
Yeah.
spend any time other than maybe finding out how leveraged they may be in their reinsuring kind of
Yeah.
stuff.
Right. So
But
you mentioned, go ahead.
yeah,
Sorry.
go ahead. No, go ahead. Go ahead.
Well, I was just going to say, you started off by saying that you've been really, really focused and kind of shocked by the four methods that cash value grows, and then we talked about interest. So, tell me more about the kind of the epiphanies you've had about the cash value growth and everything.
Well, the one the one that stuck out the most of the four was time
Hmm.
for me, because I think about that. The a lot. I think about, well, I speculate about the allotted time that I have to do what I want, uh, remaining on this physical plane. I think about it a lot more now than I probably ever have. Um, and so that whole concept of the compression of time, if you want to call it compression,
Mm-hmm.
or the shrinking of time, like, so you have this death benefit that's payable out here in the future that could, well, I don't know if it could. I think I just discovered the second oldest person was on the planet is 116,
Oh,
and so I don't know how old the number one is. I didn't find that one, but so you think these things endow at 121, but nobody's going to actually get there, but it keeps the cash value has to rise because you're getting closer and closer. And at the end, when it endows, they would need to be the same, right? The cash value. And so they're growing it. So time was the most fascinating aspect of it. The dividend and PUA, fully paid up and all that. I get that. And the PUA, the expanded PUA, beyond just the base. I get all that, but time, because I think that I'm not alone in this, that a lot of folks, not everybody, but a lot of folks don't necessarily think about the end, one of the reasons I do is because when I think I mentioned to you at some point, maybe off camera, that I had one of these, they call them NDAs for short, near death experience. And it changed the way I viewed things. And so time has become a very crucial thought, and consequently, I want to focus more deeply on fewer things. And the concept of time compressing and causing the death benefit to go up, consequently, the cash values going up too, it was actually very refreshing to see that this is actually almost like it's, in a sense, to get too woo-woo, but it's almost like it's alive, like it has life.
It's so funny because it's something you can count on.
Yes, that's what I mean by it having life. Like it's alive. It's not just some numbers on a page. It's actually alive and growing. Yeah.
That is pretty woo, Ray.
But it's so unlike all the other things that we get focused on. Like I say, I want to focus on fewer and fewer things. We get so scattered, these mechanisms, that occupy our time.
Yep.
That we go so fast, like you had mentioned, you were going so fast that you didn't have time to read that book. But look, you slowed down just enough, and your dad had made an impression on you enough that you slowed down and you took the time. And so I'm very much in the camp of slowing down, getting past all the we's and just slow down. I mean, in July, I'm interviewing a gentleman who I've interviewed before. His name is Carl Honore, and he wrote a book in praise of slowness. And he's going around the globe talking about slowing down just so that you can focus on things that really matter to you.
Oh boy, there's another conversation. It's huge.
Yeah.
It's so important. I actually had that experience this on Monday. Just because of what I do, the timing and everything, I am not able to Sabbath on Saturdays. Whatever. I think it's important we Sabbath on a day of the week at some point. Doesn't necessarily matter which day, but we got to take a day. And so Lizzie and I have been doing that for 2 years now, and it's hard. It's hard, and I don't. The only way I'd be able to explain it is this: everything takes practice, even resting. And I would have never guessed that before. But for the first 8-9 months of us being intentional about not doing anything work related or not overdoing anything entertainment or recreational, it took about 8 to 9 months for us to kind of get good at it, which is hilarious. But it did, and we fought a whole lot on our Sabbath days, for the first 8 to 9 months, because it was just weird. All of a sudden, you're used to this super busy, full life, and all of a sudden you shut everything down for 24 hours, and it's hard. It's weird, and I'm really glad we've been doing it for the last couple of years because I feel like it's the only thing that's really kept us sane in all of these transitions. And business is doing
Yeah.
well, business fails. Our other business, and um, there's a whole number of things that have just been going on that it's nice to be able to count on a day where we just are able to kind of rest. And this happened on just a couple days ago. I have been taking on so much. I think I've been taking on too much on myself about educating each of my clients. When someone comes to me, I kind of take responsibility for walking them through the whole path of becoming their own banker. When they came to me because they've been learning it on their own, right? That's not something I should take on. And if it's somebody who heard about it because of me, I need to be able to point them in the right direction rather than just educating every single person. And I've had quite a few people in the last, I don't know, 3 weeks that have asked me about Index Universal Life. How is IUL a good thing? And so I've been doing some digging and research into IULs, and been
Mm-hmm.
having conversations with people and their connection to IULs. So one of my clients and an advisor that they have that's kind of pushing IULs had a three-way conversation, and I just started to get real burnt out and trying to like help them understand the pros and the cons, the negatives, and like the big negatives, the what ifs of IUL compared to the guarantees of whole life and all this kind of stuff. And that's just one element of life that we've been going through. And I just realized, like, until I slow down, until I take that day, I'm just in it, right? But when you
Mm-hmm.
slow down and you get out of it, you can start to recognize, like, oh, that's not my lane. I need to stay in my lane. And they can, if they want to go do IULs, by all means, go do IULs, but don't talk to me about it. I'm done with that, right?
Right.
I'm happy to talk about it, but I'm also, I'm not going to be responsible for, I'm not going to advise you all of the things to look out for when you're picking an IUL. Like, I'm just not going to do that, because I don't think it's a good product either as an investment or as a banking thing. And so, yeah, that's just one element that I just got total clarity on because of resting, right? And there's quite a few other things that day. That was a really long monologue based on what you said, but we just had that experience very recently, and so
Yeah.
it's kind of fresh for me.
Yeah, well, that's great sharing, That's great to share that. That when you when well, let me just say from my experience, when I've slowed down, solutions to things that I've been grappling with just like spring up.
Mm,
Solutions like these create it seems like creativity comes to you so easily when you slow down and give yourself that sense of rest and just shutting them down. So that if you're just going through your daily life, those other 5 days that you're going 100 miles an hour, there's no room for
mm-hmm,
any creativity or other thoughts because you are the one managing all the thoughts. But if you just shut down in the sense, if you want to use that term, if you just give yourself the space to do nothing, I mean, a lot of people may not even be comfortable with themselves if
yeah.
if they slow down. They may, and really the most important person to be comfortable and love is yourself, and to be able to just slow down enough that you can uh, allow creativity and other thoughts to come in that would not come in otherwise,
Mm-hmm,
like hey, you know what, maybe I should read that book. I'll do that. I'll start next week.
mm-hmm.
Not going to start right then, which is the urge,
Right, right.
until you do it for 8 or 9 months like you did, whatever time frame it takes to get to that sense of peace where your mind and your physicality and whatever else, your spirituality, can just let go and allow your your creator to speak to you, if you want to call it that. um, I mean, that's definitely what I call it, that your intuition can speak to you and allow you to learn things that you would not otherwise have learned, because
Hmm.
in that hustle bustle of the rushing of the world, what we're talking about, becoming your own banker, is not out there.
No, it's not. For
It's
good reason
shut
too.
it's shut out. Yes, because the machinations of all the Wall Streeters and all the, whoever you want to talk about, the banks and everything else, is not allowing you to hear this, because there's so much noise. Like Nelson would say, just shut the noise off. But
Yeah.
it's a lot easier said than done,
Yeah.
because we have ramped up and we've become habitual to these technology tools. That So
Hmm.
in realizing that you have limited time for your work, limited time for your family, limited time for your spirituality and your health and everything else, what is it that you really want? Do you want to get off the treadmill, and get on a different treadmill,
Right.
maybe a much slower one? But the fascination that I had when we discussed the four things and really became clear, because it was not clear to me, because I had heard so many times, oh, it's the interest and the dividend, and that's
Hmm.
why it's growing. I mean, from people that had been at it for a long time, using those words. And I'm like, oh, okay, well, that's what it is.
Yeah. Yeah.
And then when it became clear that I was like, whoa, this is really a game changer. And it made this tool all the more powerful.
Yeah. When you
God.
understand that, everything becomes more clear. And it's funny, I get people tell me that it's not worth talking to clients about. Well, maybe not. But for me,
Huh.
if I want to, I if I'm going to invest in something, I want to know what it is. I really want to understand it. Otherwise, how can I make sure that I'm making my money, right? That's kind of my thought is if I don't know
Right.
what's going on, why should I put money in it? How much
Right.
more so for capitalizing? That's just investing, right? Investing comes with speculation. If you're going to bank, if you're going to capitalize something, you should know what's going on. And the more you know what's going
Right.
on, the more confident and peaceful you're going to be in the whole thing. And then these conversations, and I'm sorry I keep bringing it up, but IULs are just really fresh for me over the last couple of weeks.
Yeah.
I had this huge conversation, and I was just looking at the differences in the contract between whole life and IUL, and it is
Oh,
the IULs. All of the risks are put back on you, right?
yeah.
Versus
Yeah.
and the future value of that contract is not guaranteed. The future
Right.
value of a whole life contract is guaranteed as soon as you pay those premiums. And
Yes.
so it's what it blows my mind that you can have something that has a future value that's guaranteed. That fact in itself is insane. It's so uncommon. I don't know of anything else that has that. Gold doesn't even have a guaranteed future value.
Right.
Homes
that's
don't have a
that's a
guaranteed future value.
that's a good point. Yeah, gold doesn't even, uh
Cryptocurrency doesn't even
oh,
have a guaranteed future value. Nothing has a guaranteed future value. The only thing that's guaranteed in this life is that we're going to die. Some people say taxes are guaranteed, but I do know people who get away
yeah.
from those. So,
Right. Yeah. Yeah. Yeah.
um,
Yeah.
and it's
Yeah.
just a trip that the only thing that's guaranteed is that we're going to die. And until then, we're going to be alive and needing resources. So if you can put your money into a company that's betting on something that is guaranteed and they know how to make money by that time,
Yes.
that kind of makes sense.
Yeah. The idea. that it's guaranteed, the word guaranteed, you don't see anywhere else.
No. Oh my
You don't
God.
see you don't see it anywhere. So if you want to go do an IUL, like you said, Kyle, I agree. If you want to go do it, you know.
Yeah.
But
Call me in
it,
5 years.
oh God, can you
uh,
imagine that conversation?
uh,
But um guaranteed. Like everything else is not. Everything else basically has risk. But because the you know, and some people say, how can it be guaranteed? Well, just the whole thing about the time.
yeah. Yeah.
Time it's because you are going to die. That's why. If you keep making the scheduled premium payments, if you keep making those until, you know, you decide how long you want to do that, you know, that's guaranteed because of time.
Right.
And time is going to stop for you.
Yeah. Eventually.
So
That's
so if,
just insane.
so if you want to go do the IUL, go ahead. But why don't you just go in the market? You know, if you
Yeah.
want to,
Right.
So you're basically in the, you're not in the market, but you know, it's running against an index and all that other stuff. But if you want something that has basically no risk, if you want to, make those scheduled premium payments, why don't you start there? And then if you want to go and buy a stock, an individual stock, or buy an index, or whatever you want to do, go ahead. But
Yeah.
at least have this foundation that if you lose, 10, 20, $100,000 in the stock market, that you still have this foundational tool that can save you, so to speak.
Yeah.
But
You know what's funny is we're talking with these, and I'll call him John. Was the guy who was um, who does IULs, and he was that third party on that conversation, and it was hilarious because I said, so I'm just genuinely trying to understand like why someone would do this. And I asked him, I said, you've got all these guarantees within whole life, but literally the surrender charges, if you cancel an IUL policy at the beginning, those aren't completely guaranteed. The future value of an IUL isn't guaranteed. Your growth is based on market growth. A lot of times, I mean, there is a death benefit element, but all that is not guaranteed. I said, so like there's so many things that are just not guaranteed within the IUL. Like, how does that make more sense than a whole life? Even if you can make a little bit more money, like marginally more growth at the beginning or even halfway through the policy. And he goes, honestly, Kyle, nothing in life is guaranteed. So I'm like, okay, if nothing in life is guaranteed, why does that mean that you should go put your money in this thing that has a ton of risk? Like, that is a terrible argument for throwing
right.
money at something that has a lot of non-guarantees when you could put your money in something that does have guarantees. Like, it was just hilarious. And then asking him more questions. I'm not saying that everyone who does IULs doesn't understand them. I'm sure that there's a whole lot of people that are very educated on IULs and still do them. But it was sad to hear how passionate and excited he is about teaching all these people about IULs. And then I asked, what is the risk of canceling the policy in 2 years? Honestly, I'm not. In his response was, honestly, I'm not going to ever cancel my policies, so I don't even know. I was like, well, who do you have your policies with? And he couldn't remember the carrier that he had his IULs
Oh,
with. And then I
wow.
asked, and then he mentioned that he just learned about this and he already has 5 IULs, and they're all on himself, not on other people. It's 5 different IULs on himself. And I was like, okay, so you just learned about something, you're just getting into it in the last year, and your advisor encourages you to get 5 of them. That's
Hmm.
insane without fully understanding it. Oh my goodness. And being able to communicate the negatives. I mean, he could communicate the positives. Like, he's very excited about those. But I don't know, man. I just
Yeah.
think about the difference between educating and selling, and I love it
Yeah.
when people like James Nethery, he says it quite a few times. Someone told him he's the worst salesman ever, and he just took that as a compliment, right? Because his focus is education, and
Yeah.
mine is too, right?
Yeah.
I don't care if I'm a good salesman or a bad salesman. I want to make sure that people understand what they're doing, and it breaks my heart when people jump into things with both feet, and they don't understand what's going on because they're just being sold the benefits of a product, and it's only going to take time for them to realize the negatives. And I'm not necessarily saying that they're going to experience the negatives, but
Right.
maybe it wasn't the best decision. uh,
Yeah.
I don't know,
Yeah.
man.
Yeah. My most recent experience was with a young couple that, well, they're not a couple yet, but they're, they're engaged. And the young man came and talked about uh, the IUL that his uh, parents had purchased, and he said, I couldn't figure out why, when I got up into my 70s, that the cash value started to go down. And so, without going into it here, I just said, well, it's expected in most IULs. That's what's going to happen. And just when you need it most,
Yeah, right.
it disappears or it becomes less valuable. And if you keep, if your heart keeps ticking and you keep living over time, yeah, yeah. Like I said earlier, well, I shouldn't say what I said earlier. What we have heard earlier in thinking around IBC and, becoming your own banker has a lot to do with one's philosophy around how they run their life.
Hmm.
What is do people say? I don't have what's my philosophy? I don't know. Make as much money as I possibly can, as fast as I can. Um, I yeah, and even with that comment, I would say, well, uh, Warren Buffett and Munger and those kind of guys, they took the long range look in investments, and they really knew what they were getting into. They would
Hmm.
they'll study a company for 1 or 2 or 3 or 5 years. They'll study one company, before they make a move.
Well, we
And
have the benefit of seeing what they've done, and then we can make that move following them, right? So why do we need to wait
yes.
5 years? Let's just do it tomorrow.
Yeah, yeah. So, these are the things that I was thinking of, taking the loans and paying them back, and that whole thing about the money going back into the principal instead of interest, and then the whole thing around how cash value grows. I think that if someone understands those two things, you cannot say no to this.
I don't think you can either. And when
It's
you
just,
understand when you understand what cash value is, it's just the net present value of a future death benefit. That's all it is.
yeah,
And so as soon as you understand that, and you understand how time comes into play with all of that,
yeah,
and you understand that whole life has a guaranteed future death benefit, well, that all of a sudden all the puzzle pieces align. And then you look at, again, IULs. Then you dive back into IULs and you say, why does my cash value start decreasing at 65, 70 years old? Well, it's because you're an annually renewable term. The cash value is only decreasing because your death benefit is decreasing, right? So the because it's the net present value of a future death benefit, if that future death benefit is dropping, so too must your cash value, because it's only a representation.
yes.
That's it.
Yeah.
It's the tradable value. Your
Yes.
cash value is just the tradable value of your death benefit that you can access right now.
Yep. Yes. And so the opposite of that in terms of cash value inside of a whole life product that, that we're talking about is the opposite.
Yeah.
Is that the future present value is growing because it has to through time, which again is a fascinate to me, geeking out here on it.
Well,
It's
that's the thing is
fascinating.
they both do that in whole life and in IULs. The cash value always will grow to meet the death benefit by age 121 in
Yeah.
both situations. The problem is life insurance, the death benefit becomes so expensive because it's annually renewable term that in order to afford it, you have to decrease your death benefit. Well, if you decrease your death benefit, you also decrease your cash value.
Yeah. Yeah. It takes it takes more and more cash to pay for that uh renewable term.
Yeah.
So it's, yeah. And anyway, those were the things I was thinking about, that I think if somebody gets those two aspects of this, oh boy, I just wish I had found out about this when I was your age.
I love talking to young people about it. It's so much fun.
Oh
It's
yeah. And this couple that I talked to, this young man that brought up that I can't understand why at 70 this IUL is dropping in value. They are she is my youngest client, and she was still in high school when she started it. They're in college right now. It's wonderful. I got more excited about them than, sorry, any of my other clients, but but I was so excited about her starting this, because it's just crazy what happens to her policy when she gets
Mhm.
to be 70. It's completely the opposite of what he was looking at
Oh my
inside his
goodness.
IUL. It's completely different. It's like
Yeah.
you're on one side of the planet and she's on the other,
Yeah.
and she's smiling and you're not.
Yeah. uh
And so, and also I'll say, the guy that bought the 5 that you were saying, his agent sold him 5. This is just her first
mm,
policy. She's gonna rock it. She's gonna have 10 or 20. I don't know how many she's gonna have. She'll be buying them after I'm gone. She's only 19 now.
yeah.
So
It's a trip,
anyway,
man. It's
it's a
it's crazy
trip.
because his of those 5 policies, 2 of them are kind of ancillary, but 3 of them he uses to ladder. Have you heard of laddering policies?
Oh, I think I know what you mean.
So you fund one policy, you take a loan to fund the next policy, take a loan from that one to fund another one. So you're
Hmm.
always increasing your loan balance. When his system implodes, that dude's going to go into depression like you can't even imagine. And it's only a matter of time before
Yeah.
that implodes. You're way over leveraged.
Yeah.
It's
Yeah.
so sad.
Yeah. That's a house of cards just
Oh
waiting.
boy. Oh
Yeah.
boy.
Too
Yeah,
bad.
anyways, I
We can't, like we were talking earlier. You can't, you get burned out if you try to save everybody or convince everybody. We're
right.
not here to we're not here to convince. We're just here to show and teach, and
And
and prove it too. I mean, you can prove it pretty easily. This is the way it works. You can just look at it now. Illustrations are just a snapshot, but historically, well, before the 70s, when A.O. Williams started talking about buy term and invest the rest, before all that, people, through the Great Depression, many, many, many families survived because they had life insurance, which had
mm,
cash value inside of it. And they didn't have the extra PUA driver that we have today. That's even new. I mean, they didn't have that, but
yeah.
they had what I would call, I think people use the term vanilla. where 100% goes to base, but it grows over time and you have cash value. And that's how they survived. A lot of families survived using loans from their life insurance policies. Everybody had it. It was part of their savings program, and protection program. So anyway,
No, that's a good point.
now I feel
That's
like
good.
I'm rambling.
Well, it's good to bring up, and we work with companies who are over 100 years old and that have been paying dividends. They were profitable through the Great Depression. There's not a whole. Were banks profitable during the Great Depression? No.
Most, no. Actually,
No.
way. I mean, I can't remember what the number is, but it's very high in the thousands that went under.
Yeah. So where are you going to warehouse your wealth? It's important.
Yeah. So they go under, but the insurance companies, a few went under. Probably more of the stock owned ones, but yeah, because they're not fractionalizing like banks. Yeah. So anyway.
Yep. Well, awesome, man. Guys, thank you for listening. Thank you for hearing us out, as we didn't have a topic, but again, and I love chatting with you, Ray, because it's always a fun, stimulating conversation, and always so many different things get brought up. So yeah, thank you guys for listening. Please like and subscribe, whatever channel you're listening to, whether it's Apple Podcasts or Spotify or whatever, YouTube.
Yeah, whatever. Yeah. I like talking with you too, Kyle. Yeah, it's great fun. I thought this went well in terms of, not having a topic right, off the top of my head. But this morning I said, I think I want to talk about that again. So if you could subscribe and like and share this, it would be immensely appreciated. And if there's ever anything we can do for you, you know how to get a hold of us, because our contact information, you decide. You can call both of us if you want.
Yep.